right? That's the Fed chair. Now, Steve Englander is global head of G10 Forex Research and North America Macro Strategy at Standard Chartered Bank. Steve, great to have you on the program. Thank you very much for your time. Let's just start with your views on where the dollar is headed, and let's take the dollar index, the U.S. dollar index, as a measure. What is your sense, Steve? It's been to some surprisingly extremely weak. It's given up pretty much all of the gains, recent gains. Are we headed a lot lower? Because that has got implications for portfolio flows into emerging markets. Go on.
Well, we think it's headed lower. It certainly has gone faster than we expected, but the forces behind the move are the forces that we expected to be there, just playing out quicker. It will have an impact on emerging markets, but in the first instance, we think it's mostly a G10 move. And in particular, we think Asian currencies could lag a bit, possibly excepting China, but looking at non-China Asia currencies, the case for them kind of leading dollar weakness is not strong. We like the euro stronger. We like the yen stronger. We think Aussie could be stronger in coming weeks. And again, I think we would say that there's some risk in the dollar having moved as fast as it did, but we don't think that the moves are unjustified, and we think that there's more to come.
Okay, Steve, hi, good morning. Let's talk a little bit about what your expectation is from the Fed. Is there a stronger case for a smaller 25 basis points rate hike in the February meeting of the Fed if the CPI data out tomorrow indicates a softening of inflation?
Well, I think that's a very strong case. Even if it comes in, say, 0.3, which is in line with the market expectation, I think the signal that the Fed is sending is that they would much rather move less and keep it steady for an extended period than move further sharply up and then have to cut sharply later in the year. So, I think that the market is waiting to see what the CPI says. And I think even if it comes in line with the market expectations, say core at 0.3, we could see the dollar weaken off that as the market draws the conclusion that inflation is indeed slowing, and it's just a matter of time till it slows further.
All right, Steve, a couple of questions out here. For the year, how many rate hikes are you factoring in from the Fed? Point number one. And the dollar index, I recall the last time you joined us, you were suggesting that maybe the dollar index will weaken, and that's precisely the way it's played out. We're at around 103 odd. Is there a level you're looking at on the dollar index?
Well, we actually expect only one more hike, and we expect 25 basis points at the end of January, February 1st. But I think it's the drivers that matter, and I think that in a sense there's a consensus both in the market and probably even at the Fed that if the economy begins to slow down, markedly, that the Fed is going to pause. Now, we think that the data in the next couple of months will be slow enough that they pause, in March. The market thinks it could happen by September. By the middle of the year. And the Fed is sort of a little bit reluctant to commit on that. But in some ways, I think the market is waiting for a shoe to drop in terms of an economic slowdown. That would be the trigger for that kind of slowing. So, as I said, we expect one more hike of 25 basis points, followed by ongoing slowing in the economy. In terms of the dollar, we think that probably about 3 to 5% more weakness on the dollar, in the course of the year. Risks actually maybe even to the upside on that. The U.S. cycle, we think, is slowing. Europe is outperforming. China is reopening. That's going to have an impact on the rest of the world. The dollar did very well last year when the U.S. cycle was ahead of the rest of the world, and now that's changing.
Okay. Steve, so in terms of the other side, right, we're all focused on rates, and you said maybe the Fed pauses in March. So two questions. One, they pause and then hold rates where, they will be in March through the end of the year, or they, in your opinion, they cut at some point? I mean, I think the market pricing indicates 50 basis point cut late into 23. That is one. And second, when you say that the market is waiting for the shoe to drop, which is economic growth slowing significantly, will it be sharp slowing? Because that will be negative equities, right? It may mean another thing for rates. So quick views.
Yeah, not sharp slowing, but it's sharp enough to get the unemployment rate up. And in fact, we think kind of the signal for the Fed to start easing slowly would be, say, if the unemployment rate went above 4.5%. So that's probably a late 2023 type of move. But we don't think they're going to cut rates fast, and we don't think the economy is going to slow in a dramatic fashion, but it will slow and the unemployment rate will go up.
All right, Steve, we will leave it at that. Thanks a lot for joining us. We got the point. Fed is perhaps going to go slow on rate hikes, and in the February meeting, you're expecting just one more hike of 25 basis points. Let's see. The inflation data out tomorrow will indicate whether inflation is cooling or not, and then perhaps the Fed can go slow on rates. That's the narrative at least. Let's slip into a quick break. On the other side, our entire team will be with us to help us with the list of top 10 stocks. Stay tuned.